Welcome to Financial Freedom and Finance channel. Here we upload videos to give you a helping hand in reaching your financial goals. We hope to give you tips for achieving financial freedom using finance, one video at a time. If you are new here, do not forget to subscribe to our channel for more videos about financial literacy. The lesson today will explain how to more effectively manage your money with the 50-30-20 rule. The beauty of the 50-30-20 budget is in its simplicity. It might assist you in categorizing your income to make saving simple. Budgeting doesn't have to be difficult or take up a lot of your day. In actuality, the simplest budgeting methods are frequently the best. Consider the 50-30-20 rule as an example. The 50-30-20 rule is an easy monthly budgeting technique that outlines exactly how much you should allocate to savings and living expenses each month. You can safely avoid overpaying and gradually increase your savings with a clear big picture overview of your monthly budget, all without meticulously keeping track of each and every purchase. So, you might want to try the 50-30-20 strategies if you've ever downloaded a budgeting software only to delete it after 3 days. Here's how it works. 1. It's of the greatest budgeting advice we've come across. The 50-30-20 rule is what? The 50-30-20 rule is a simple budgeting technique that can assist you in managing your money in an efficient, straightforward, and sustainable manner. The general rule of thumb is to allocate 50% of your monthly after-tax income for needs, 30% for wants, and 20% for savings or debt repayment. You may make better use of your money by consistently maintaining a balance between 3 key areas of expenditure. You can also save yourself the time and frustration of going into the specifics every time you spend by keeping track of only the 3 main categories. Why can't I save more is a common query when it comes to budgeting. That age-old conundrum can be resolved, and your spending habits can be made more structured by using the 50-30-20 guidelines. Whether you're trying to pay off debt or save money for a rainy day, it might make it simpler for you to achieve your financial objectives. The 50-30-20 rule, where did it come from? The All You're Worth, the Ultimate Lifetime Money Plan book from 2005, authored by current U.S. Senator Elizabeth Warren and her daughter Amelia Warren Tyagi, is where the 50-30-20 rule first appeared. Warren and Tyagi draw the conclusion that you don't require a complex budget to keep your money under control based on more than 20 years of research. The 50-30-20 guideline will help you manage your spending between your needs, wants, and savings goals. How to set up a financial plan using the 50-30-20 rule. Budgeting is made easier by the 50-30-20 rule, which divides your after-tax income into just 3 categories: needs, wants, and savings or debt. It will be simpler to stick to your budget and control your spending if you know exactly how much to spend on each category. Here is an example of a budget that follows the 50-30-20 rule. Give 50% of your income to necessities. Simply expressed, needs are costs you can't avoid, amounts needed for all the necessities without which it would be challenging to survive. Your most essential expenses should be covered by 50% of your after-tax income. Typical needs include regular rent, gas and electricity bills, transportation, insurances, for healthcare, car, or pets loan minimum payments, basic provisions. If your monthly after-tax income is $2,000, for instance, $1,000 should be set aside for your requirements. This spending plan may vary from person to person. If you find that your demands total more than half of your gross income, you might be able to make some adjustments to reduce those costs. This could be as simple as switching to a different energy supplier or discovering new strategies for grocery shopping financial savings. It might also imply more significant life adjustments, like looking for a less expensive place to live. Put 30% of your income toward wants. Your most basic needs can be met with 50% of your after-tax income, leaving 30% of your after-tax income for wants. Wants are things that you choose to spend your money on even if you could live without them if you had to. They are considered non-essential expenses. These may consist of dine outside, purchasing clothing, holidays, joining a gym, entertainment packages, Netflix, HBO, Amazon Prime groceries, other than the essentials. If your monthly after-tax income is $2,000, for example, you can spend $600 on your wishes. It's also worthwhile to consider which of your wants you may cut back on if you find that you're spending too much on them. As a side note, adhering to the 50, 30, 20 guideline does not exclude you from having a good time. Finding areas in your budget where you are unnecessarily overspending is all that is required to become more frugal with your money. Simply ask yourself, could I live without this? If you're unsure of whether something is a need or a want, that's probably a want if the response is yes. Put aside 20% of your income as savings. The remaining 20% can be used to reach your savings objectives or pay off any outstanding debts after allocating 30% of your monthly income to desires and 50% to necessities. Even though the minimum payments are seen as necessities, any more payments are regarded as savings because they lower your current debt and accrued interest. You may create a stronger, more enduring savings strategy by consistently setting aside 20% of your monthly income. It doesn't matter if your ultimate objective is setting up an emergency fund, creating a long-term personal financial plan, or saving for a down payment on a home, this is true. Furthermore, it's amazing how rapidly savings may accumulate. If your monthly take-home pay is $2,000 after taxes, you may allocate $400 to your savings objectives. You'll have over $5,000 in savings after just 1 year. An explanation of how to use the 50, 30, 20 rule in detail. So how do you use the 50, 30, 20 guideline in practice? You must compute the 50, 30, 20 ratio depending on your income and categorize your expenditures in order to put this straightforward budgeting concept into practice. This is how. 1. Determine your income after taxes. The 50, 30, 20 budgeting guideline requires you to first determine your after-tax income. Your monthly revenue as a freelancer, less your company expenditures and the amount you've set up for taxes, will be your after-tax income. This will be simpler if you have a consistent job and a paycheck. See how much money is deposited into your bank account each month by looking at your payslip. If contributions for pension funds or health insurance are automatically taken out of your salary, add them back in. 2. Categorize your spending for the past month. To get a true picture of where your money goes each month, you'll need to see how and where you spent your income over the past month. Grab a copy of your bank statement for the past 30 days, or simply use the Insights feature in your N26 app. It automatically sorts all your transactions into categories such as salary, food, and groceries, leisure and entertainment, and more. Now, split all your expenses into the 3 categories: needs, wants and savings. Remember, a need is an essential expense that you can't live without, such as rent. A want is an additional luxury that you could live without, such as dining out. And savings are additional debt repayments, retirement contributions to your pension fund, or money that you're saving for a rainy day. 3. Review and tweak your expenditures to adhere to the 50, 30, 20 criteria. You may begin to modify your budget to adhere to the 50, 30, 20 rule once you have an understanding of how much of your income is allocated each month to requirements, wants, and savings. The easiest method to accomplish this is to evaluate how much money you spend each month on desires. A wish is not excessive, in accordance with the 50, 30, 20 guideline, rather, it is a fundamental nicety that enables you to enjoy life. It's better to figure out which of your desires you can cut down on to keep within 30% of your take-home pay, because cutting back on your necessities might be a difficult and complex undertaking. Your chances of reaching your 20% savings goal increase as you cut back on your wants-related expenditure. That is it for today's video. I hope you were able to learn a thing or two about the 50, 30, 20 rule, handling your finances, and where you should get started if you want to achieve financial freedom. We will see you in the next video. Thank you for watching.